and welcome to the latest edition of the Economist Intelligence Unit's Global Outlook video. My name is Agathe Demarais, and I'm the Global Forecasting Director at the Economist Intelligence Unit. I'm joined today by Nick Marro, the Economist Intelligence Unit's lead on trade and Asia analyst, and Matt Oxenford, an analyst in our Europe team. Today, we're going to discuss trade topics with the latest on US-China tensions and Brexit. One word about our latest global outlook. We now believe that global output is going to contract by nearly 5% this year as a result of the coronavirus pandemic. We think that the US output is going to contract by 4.8% and China's growth is going to be a mere 1.4%. This matters a lot because the US administration, led by President Donald Trump, is trying to shift the blame away from the US administration to China for the pandemic and its economic and social consequences. So I'm going to turn to Nick now to discuss this because Nick, we've seen over the past 6 months that coronavirus was making the headlines, but it doesn't mean that nothing was happening on the US-China front. So Nick, maybe can you walk us over what happened over the past 6 months on the US-China front?
Sure. Well, right before the pandemic, there was actually a lot of hope in US-China relations, primarily because we saw the first phase trade deal signed in January. And we at the EIU were initially hopeful that this was going to be somewhat of a stabilizing force for global trade this year. I mean, the first phase accord didn't end the trade war, but the freeze on tariffs provided some much needed stability and certainty for consumers and businesses. And even as we expected US-China frictions to continue this year, the trade deal would have at least prevented a rapid or radical deterioration in the relationship. But COVID-19 has essentially undermined all of those assumptions, particularly as the US and China spar over the responsibility and the handling of the crisis. And this is important for multiple reasons. One is that the pandemic has complicated the implementation of the first phase trade deal as demand dynamics and production and logistic networks have been disrupted. But beyond that, the pandemic has also erased a ton of the goodwill that might have anchored the US-China trade relationship this year. The continued cooperation and sustained dialogue framework mechanisms underneath the first phase accord would have been necessary to keep the trade or diplomatic tensions from boiling over. And these are no longer stabilizing forces in the relationship.
So Nick, maybe a very simple question, yet I'm sure it's hard to answer in a nutshell, but do you think that the US-China trade deal is in jeopardy?
Well, I think we need to caveat that by saying that things could always change overnight, especially in an era of foreign policy by tweet. But on balance, the EIU does not expect the US-China trade deal to fall apart this year. We do expect it to survive at least until the elections in November. That's for a number of reasons. Even with the deterioration in US-China ties, President Trump looks to be maneuvering quite carefully. He doesn't want to weaken the US economy when it's already been battered by the pandemic by, say, squeezing US consumers and businesses with higher tariffs. Moreover, there are some encouraging signs at the working level. So, for example, the US Trade Representative, Robert Lighthizer, he's generally come out in support of the accord. His recent congressional testimony has been pretty positive in this aspect. And really, Lighthizer has been the man to watch in terms of assessing the US political will around the trade negotiations and the survival of the deal in general, even if other aspects of the administration seem a bit more hawkish in the US. I mean, there's also a risk that China could exit from the deal, but we expect this risk to be relatively low. The Chinese economy is in a very precarious position. Agathe mentioned that we are expecting the economy to only grow by about 1.4% this year. And the consequences of exiting the deal, whether that results in a reintroduction of tariffs or damage to consumer market sentiment, that could really be costly for China and derail any type of economic firming that we might see in the second half of 2020. Now, none of this suggests that US-China relations are going to improve in the near term. Even if tariffs remain off the table, the US has adopted a wide range of economic measures against China, particularly over the last month. This has included an expansion of its export controls on Huawei and other technology companies that lie at the heart of the US-China technology war, as well as some moves by the US to cut back some of its financial linkages with China. Now, these measures are designed by the US to place significant pressure on China, particularly in technology, but also in ways that will contain any blowback on the US economy. And that's going to keep them as attractive policy tools moving forward. This also suggests, however, that Chinese retaliation against US firms or other foreign firms in its own market might be inevitable, whether that's via discriminatory policies or other trade measures such as the unreliable entity list. All of this, however, is in line with our long-held forecast that trade frictions are going to increasingly spill away from tariffs and into the technology, finance, and investment and national security arenas when it comes to US-China. I think that's complicated as well by the fact that standing up to China in the US has also emerged as a bipartisan issue. And so these dynamics are likely going to persist beyond November, regardless of who wins the White House.
So talking about the US presidential election, and actually we've just published a white paper about our forecast for the US presidential election. What do you think that the US election means for China, and maybe could a Biden presidency allow for pressure to recede a little bit?
In short, no. So, the US presidential elections always involve a degree of China bashing, but the dynamics this year are even worse this time around. Biden himself has come under a lot of pressure to look tough on China. And we don't really just see this as political posturing. We do expect this to lay some of the groundwork for his core policy choices if he were to win the White House. Now, a lot of this is going to be driven by adjacent issues outside of just US-China trade. So the ongoing erosion of Hong Kong's political autonomy, for example, or the human rights abuses in Xinjiang, those have already paved the way for targeted US sanctions. The US public is also increasingly paying attention to these topics, which is a relatively new dynamic in US-China relations. And that's going to put pressure on US domestic policymakers to maintain their hardline stance on China, which, as I mentioned, is increasingly a bipartisan issue. Now, under a Biden presidency, we would expect the US's China strategy to shift a little bit. So the US trade policy over the past 3.5 years has been relatively erratic. Even as the US has targeted China, it's also threatened trade and tariff actions against some of its other security and economic partners, often for relatively flimsy reasons, and that includes Japan, Australia, and the EU. Now, we'd expect Biden to walk back that type of trade aggression, not on China, but towards other countries. That could give the US a bit more space to form more of a like-minded coalition on countries to pressure China, chiefly on economic issues, but perhaps on other topics as well. And that's being driven by separate factors as well. There's growing diplomatic fallout between China and a lot of other markets, including the EU, Australia, and India. And that suggests that there's global appetite for such a US strategy. Now, under a Trump second term, we wouldn't expect this type of engagement strategy to emerge, particularly because the frictions between the US and Europe would likely continue to deepen. But the risks in the US-China relationship more generally would still be very high. Under a Trump second term scenario, we might have to reassess the various quote unquote nuclear options that might come out in the US-China conflict. That could include the US restricting the access of Chinese companies to US dollar denominated financing systems, or unveiling an executive order to demand US companies reshore back to the market and reduce their reliance on China. And overall, the erraticism of US trade policy would persist, and a high degree of uncertainty would remain in the market. But what we at the EIU are certain about is that the trade outlook for China, and probably for much of the world, will remain gloomy regardless of the election. And that in turn could complicate any type of economic recovery that we might see in the post-COVID-19 period.
Thanks so much, Nick. That was a fabulous summary in 5 minutes of the US-China front. So I'm going to turn to Matt now to discuss the latest developments on the Brexit front, another complicated trade topics. So Matt, where do the UK-EU negotiations currently stand? And maybe coronavirus questions. Has the coronavirus pandemic changed the timetable?
Well, Agathe, thank you so much. The outcome for the pandemic in Europe did postpone talks between the UK and the EU for over a month back in March, not least because at one point, the chief EU negotiator, Michel Barnier, and the chief UK negotiator, David Frost, both had to self-isolate with coronavirus symptoms. The talks resumed in April and have proceeded over video conference through June, but the talks have made very little progress, with disputes over fishing rights and level playing field provisions, the same provisions that have dominated the debate since February, remaining the key sticking points. Governance has also emerged as a tricky issue, where the EU would like one unified architecture to cover trade, security, defense, and all the other issues, while the UK would prefer a series of piecemeal deals with trade proceeding on a completely separate front. At the same time, the UK government, despite these delays, has decided not to extend the transition period. Their view has always been that the only way to force talks to move forward and have a breakthrough on these tricky issues is to have a hard deadline and allow the possibility of a hard break. Even though Brexit talks have reached this impasse at this point, though, it's not uncommon in trade deals, and it also wasn't particularly unexpected. Both Mr. Frost and Mr. Barnier are civil servants, and they're bound by the mandates that were set by their governments, and so they have very limited room to compromise on their own. This means that to get a deal, political leadership has to intervene, both at the UK and EU level. And over the last week or so, we've seen Prime Minister Boris Johnson stepping up his personal involvement, meeting with the heads of EU institutions, as well as key European heads of government, such as President Macron of France. If there is going to be a compromise, it'll have to be concluded on this level, and we're likely to see significantly more diplomacy on that level in the coming weeks. Mr. Johnson has said he wants to have a deal concluded by the end of July. I think this is relatively unrealistic. Our view is that this is relatively unrealistic, especially considering that there are currently negotiations scheduled through August and September. What's more realistic and a more realistic ambition would be for some sort of high-level breakthrough on fishing rights or the level playing field to happen at some point in the next month or two that would allow talks to move forward in the remaining time. It really doesn't help anyone if Mr. Frost and Mr. Barnier are allowed only to repeat the mandates from their governments through another 3 rounds of talks.
So given all the constraints that you've outlined, and there are many constraints, how would a deal look like, and what are the chances of a no deal?
Well, as I said, there are real differences on the sticking points of fish and the level playing field, but observers of the negotiations have identified a landing zone, and these differences are bridgeable if there is willingness to compromise. On fish, the UK wants to establish the principle that it has control over its own territorial waters and to secure a better deal for UK fishermen. But at the same time, the EU wants certainty for its own fishermen and continued access to UK waters. Compromises such as maybe the UK negotiating fishing quotas with the EU on a multi-year basis could satisfy both the EU demand for certainty, but also give the UK more control and more autonomy. Similarly, on the level playing field, the EU is very adamant that it doesn't want the UK to have preferential access to the single market if it can undercut EU standards on labor, environment, state aid, etc., and so wants the UK to remain aligned to EU provisions on these standards. The UK at the same time doesn't want to just become a rule taker from Brussels or be under the jurisdiction of the European Court of Justice. But again, there is a potential compromise here, some sort of non-regression that falls short of the EU's demand for a dynamic alignment with EU standards, or possibly tariffs that would be imposed conditionally if the UK exercises right to diverge from EU standards. Any of these can be used as a compromise that wouldn't take EU standards as a baseline. However, even if a deal is reached, we expect it to be a far cry from a comprehensive deal. A lot of the highly technical provisions are likely to take some time to agree on, and this is most likely going to happen after the deal itself is implemented in December. This will also allow for a more phased transition at the UK border, both in Dover, which has significant logistical issues it has to overcome in the event of no deal, and also in Northern Ireland, where the implementation of the protocol agreed last year is behind schedule, and if it isn't implemented properly without some sort of amendment in the final deal, would put the UK in breach of its treaty obligations. In terms of no deal, that's very much a high risk, and we see it as a very high risk, but it also carries a significantly more economic cost than it did before the pandemic. Back in February, the government had assumed that if there was no deal, businesses could be able to adapt and innovate and find new markets when faced with higher trading costs. However, given the strain that businesses are already under, a further strain of a no-deal Brexit could push many of them out of business and create much more short-term disruption than was expected previously. That being said, there is a large faction of the Conservative Party that will be very skeptical of any compromise with the EU, especially because it will probably be short of the clean break that many of them want. It's also unclear how far Mr. Johnson himself is willing to go to compromise, given what happened to his predecessor, Theresa May. The EU itself also has limited capacity to engage with Brexit, and many people in Brussels are skeptical that the UK even wants a deal at all. Mr. Johnson's been pursuing a very high-risk strategy of brinksmanship, and that strategy remains so even now.
So how do the Brexit negotiations affect the UK's outlook beyond 2021, especially in the light of the pandemic?
Well, untangling the economic impact of Brexit versus what the economic impact of the coronavirus will be very difficult. Even if there's a highly disorderly Brexit, the year-on-year growth figures in 2021 will still likely reach record highs, simply because the 2021 figure will compare to the lockdown year of 2020 very favorably. However, that doesn't mean that we expect the impact of Brexit, especially if it's no deal, to be hidden by the coronavirus in any way. The UK, we currently forecast, is not going to reach its pre-pandemic level of GDP until late 2023. And if a disorderly Brexit delays that even further, the government becomes at real risk of facing its next election in 2024 with a smaller economy than it did during its previous election in 2019. So the growth incentive is very much there for the government. And the UK does have advantages in pursuing growth. It can borrow in its own currency, and we've seen cooperation between the Bank of England and the government that's far greater than the monetary fiscal cooperation that we've seen in the US or in the Eurozone, which gives it a lot more fiscal space than its high headline level of debt might suggest. It also has significantly innovative sectors, particularly in the technology area, and a very flexible labor market. And the government is committed to greater public investment to level up its regions, which has been a historical weakness in UK policymaking. However, at the moment, this commitment to greater investment is somewhat disjointed. The government seems to be pursuing Brexit negotiations and managing the coronavirus fallout on separate tracks. For example, the UK's furlough scheme is set to expire in October, shortly before the Brexit deadline is going to create even more disruption in the labour market. The Chancellor of the Exchequer is expected to outline a stimulus and investment plan at some point in July, which we view as a key test to determining whether the government has a joined-up plan for growth and investment that will be able to counteract these shocks, or whether these shocks are sort of going to proceed on their own. It's also worth noting that the UK has had a very poor response to the pandemic itself. Much of this has been due to locking down later than other European countries and has put it behind in restarting its economy. We expect going forward, the UK will manage its reopening and any further outbreaks about as well as its peer countries, but the risks are high across the region, including in the UK. However, at the same time, the high death count on top of Brexit disruption does take a significant toll on the UK's reputation and its soft power, and this will have a strong intangible cost of some sort going forward.
Thanks so much, Nick and Matt. That was a fascinating video on trade. You can always find our latest analysis on www.eau.com, our website, with our latest insights on trade, on Brexit, on US-China, and also some white papers. I was mentioning that we've just published a white paper on the US election, for instance, or on the response of various OECD countries to the coronavirus pandemic. You can also follow our analysis on our Twitter feeds. Our handles should show nicely on the screen, or again, on our website. I hope that you enjoyed the video, and I look forward to recording the next video next month. In the meantime, stay safe. Thanks very much for joining. Bye-bye.